Welcome to a new series. We're launching Finfluencers, taking a look at the people who influence the way retail investors are thinking. My first guest, a veteran fund manager who's suddenly switched from growth into resources and value investing. Delighted to have him as on the show, and we're going to learn a little bit about his approach, the stocks he holds, and the reasons why. Let's go take a look. I'm delighted to have John Rosier here as my first guest. Welcome to the show.
Thank you. Great to be here.
Thank you, John. And before we start, I mean, maybe we could learn a little bit about your background, your long-term fund manager, etc., and then when you launched effectively your newsletter and the two model portfolios.
Okay. I started work in the city at Robert Fleming in September 1984. And I spent sort of 4 years in the research department there. So I was following financials, food retailers, textiles, quite a mixture. And then in '89, I moved up to actually managing portfolios. I was on the side that looked after UK equity portfolios for big pension funds. So it'd be, local authority pension schemes or big corporate pension schemes. And I did that at Fleming's for 9 years, ended up as head of UK equities. Then I moved to Henderson Global Investors. So I was a director there, doing a similar job. And that was good fun at Henderson because I joined after a period where their performance hadn't been that good, but was on the up. And within a few years, we were winning a lot of new mandates and things. So that was fun. It was very different from what I do nowadays because in those sort of portfolios were all about, well, the target was to beat the all share by 1 to 1.5% a year, which you do that over years. The compound effect is very important, but the risk was pretty controlled. So you spend a lot of time in meetings going, Shell is 5% of the index. Should we be at 6 or 7 or 4 or 3? But not holding any Shell was really something that would have been too risky. Anyway, after Henderson, I spent a few years trying to do some hedge fund stuff. And I'll be perfectly honest, I wasn't very good at it. I found shorting stocks very difficult. Psychologically, it was difficult. Being short of a stock that's going up, I was sort of going, well, why am I doing this? I like to invest in companies that are doing well, and I'm short of, so it didn't work. Then in 2008, I set up a fund management firm called Blue Oar Asset Management, subsidiary of a new company. Difficult time to do that. But we got 2 portfolios going. Then we move into 2009, and unfortunately the parent company was taken over. The new owner said, we're not interested in fund management, so close it down. So that was a bit of a blow, but anyway, spent 6 months doing that. I then had a few months out, and when I was out in that time, I actually went to South Africa, and I spent a month doing conservation work. I'd done zoology at university. So it took me back to my roots. And actually, I came back from that and I thought, I've really enjoyed my career. I love investing, but I'm not sure I want to go back to the city. I spent 25 years there. So I then started doing my own sort of investing. And by doing that, I was looking for information. And the internet's obviously made a huge difference. And there's a lot of and every day there's more product that the private investor can get hold of. But out of all the work I did came an idea, and it was about setting up John's Investment Chronicle, the investment diary, of a private investor.
And what was that? So you run 2 model portfolios, one in sort of direct equities and one in closed-end vehicles and OIGs. The idea of this is that you've got a following, that when you trade in something or do something in the portfolio, they hear about it. Just run us through what that newsletter is about.
The whole aim of it is actually to be educational. I don't want people to blindly follow what I do.
Yeah.
So you said there's two portfolios. The first one I started in January 12. So that was the portfolio that just invests in stocks and shares. And I've never held more than 30 stocks, never less than 20.
Yeah.
And it's generally UK, except for themes. If there's a theme or overseas exposure I want, then I'll do it through an investment trust. But the idea was to show my portfolio and explain any changes I made, why I've made them, and any updates. So if I trade, to update within 15 minutes, showing the contract note, so that investors can then read why I've done that and see the portfolio and see where that fits in the portfolio.
Yeah.
So it's not really tipping individual stocks or anything like that. And I always think about tips. See, about tipping, and there's plenty of people who'll tip. They'll tell you to buy something, and in a year's time, they'll say, "Do you remember I told you to buy that? It's doubled."
Yeah.
The one they told you to buy that's halved or gone down, they'll quietly forget.
Mm-hmm.
I can't do that.
Yeah.
It's in my portfolio.
Yeah.
I buy something and the next day, and I've had this, that literally the next day there's a trading update, which, let's say a profit warning, and the stock's down 30%. And you have to deal with it.
Yeah, no, and look, I mean, that's part of the reason we wanted to do this kind of show, because, as you say, there's this huge volume of information out there. I think it's trying to get people to focus on, where there are people who are taking a sort of sensible approach, etc., rather than the sort of, the guys who are ramping stocks and getting people in and out, etc. And, I think our aim is to try and speak to individuals who we think actually go about this in a sort of sensible way. It's been an interesting year to be managing a portfolio.
Yep.
And I think when I look at we also run a model portfolio, and when I look at it, actually probably the biggest detractor was Putin's invasion and the impact that had actually on the portfolio. The second part of it is, of course, the sort of rise in inflation and rising rates, the change in sentiment that's had on the market. I've had a number of sort of professional institutional investors coming here, and I think that there's a diversity of opinion out there. There's those who believe that inflation is sticky and hard to get rid of, and it's here for many years to come. There's others who'll argue that it's transient, and really, I'm not sure. It's very hard to call who's right. What's more interesting is how do you position yourself in light of that. So, I wonder if you could open up in terms of today, how you're looking at the world and how you're thinking of positioning yourself, and also hint at and talk about some of the themes that you're interested in.
Okay, absolutely. I mean, I tend to take a sort of pragmatic approach to things. So. A year ago, or just over a year ago, any sort of growthy stocks I had, and in the funds portfolio, so as you mentioned earlier, the second portfolio I launched in July 2020, and that just invests in investment trusts, some funds and some ETFs, but mainly investment trusts. And a year ago, almost exactly now, I cut things like I had a cloud computing ETF, I had a semiconductor ETF, a video gaming ETF, also a NASDAQ ETF. So I had quite a lot of exposure to the US, but also to highly valued growth stocks, and I sold them. So, and I made it very clear there's this change of theme, and I was moving more towards value stocks. So this year, things like Temple Bar Investment Trust came in, very much a value portfolio. And also I increased my resources, which I'll talk more about later on. So I think that you need to be invested for how the market conditions are, but I don't see that the shift to value that I've made is something that is short term. I think it's going to be there for a good few years. I mean, inflation, sticky, transient, whatever. I mean, for what it's worth, and it shouldn't be worth much, I think it's going to be sticky.
Yeah.
Because although, you mentioned Putin's war and the effect that's obviously had on energy prices, they were moving up before then. If you looked at the gas price, it started moving up in the second half of last year.
Yeah.
From June, moving up quite significantly. And I think high energy prices are going to be with us for the rest of the decade.
Yeah.
Because the move to renewables means that there's not been enough investment, or say enough, got to choose my words here, but there's been less investment in oil and gas, as the big majors and things have been moving towards investing in renewables, selling off their North Sea assets to people like Serica, which is my largest position.
Yeah.
And at the same time, you're getting a huge increase in the amount of electricity that is going to be needed to fund us getting to net zero.
Yeah.
Charging up electric vehicles, heating for homes, making hydrogen, whatever. It's going to need a lot more electricity generation capacity. And this can't all be met by renewables. And the other problem, obviously, with renewables is that you have this intermittency problem.
Yeah.
And part of the reason when I talked about the gas prices moving up in the second half of last year was because during August and September, Europe was largely windless. There was very little wind. And we, at the moment, we're having a fantastic November, and it's good news in terms of, wind power and also less, the higher temperatures.
Yeah.
And that is good news. But there will be times when you have very still, cold week or 2 weeks, and the demands will be high. So I'm playing this in two ways, through oil and gas positions. Serica, I mentioned, is my largest position. I bought that first in April 2018, around 80 odd pence. It's now 300. It's paying dividends. A recent purchase was Harbour Energy, which is a FTSE 100 company.
Yeah.
Again, generating lots of cash, which the government wants to get its hands on, or more of its hands on.
Yeah.
And but that yields 5-6%, should be debt free middle of next year, and the price to cash flow very, very low. So I've got the oil and gas plays.
Yeah.
But then the other big theme for me, and I've got nearly 25% in resource stocks.
And that's the view that you can't meet net zero without the resources to do it. Is that what's driving that?
I mean, I spend a lot of time reading things, and I mean, anyone can sign up to Wood Mackenzie. They're very highly respected resource sort of analysts, and they put out a paper a few weeks ago, which actually was very fortuitous because I was writing
the copper one, I think.
Yes, the copper one, and it was very fortuitous because I was starting to write something on this. See, I wrote a big thing a year ago about why I was keen on resources, and I thought I'd follow it up a year later. How's it done for me?
Yeah,
it's done pretty well. Things like BlackRock World Mining are up 25% over the year and paying a nice dividend. But also, what did I think going forward? And that actually, I'm even keener on.
Yeah,
because there's just not enough copper, nickel, cobalt, lithium, and the prices are going to go up.
Yeah, and it's an interesting that view. I think the demand side is understood, that there is this drive towards sort of net zero. It's creating sort of a tailwind for demand for different. I also think the interesting thing is that we're moving into a world of capital scarcity. So if you've got the resource, it starts to become more valuable, etc. If you're a listed company with that resource, you've got the funding to effectively get that out. So I think that that's a really interesting theme.
Yeah.
Let me just walk me through. So I understand the themes. Let's walk through the discovery process. So, when you're playing out these themes, what's the old school mentality of let's research this stock? What do you do?
Right. Well, I use a lot of resources, things like Stockopedia, which I find useful for screening companies. So you could look at a particular sector, then you can rank it on price, cash flow, anything you like, and it's very user friendly. So I'll use things like that. I use things like Edison. I watched the interview. Well, it's the third largest holding, Sylvania Platinum. I watched the interview the other day with the CEO, and I read the notes from the analyst. So, and that's a good thing because there's more of that available than there was 10 years ago. Because that was the really difficult thing, actually, for a private investor to actually get hold of research. It's still difficult, but there's things like yourselves, Research Tree, and things that so you can get hold of some brokers' notes. I also do. I use ShareScope to manage my portfolios. I find it user friendly, and every day, at the close, when the price has been updated, I can press a button and I can see stocks that have hit 3-month highs. And I see that and I look down the list and I think, okay, and then I'll screen and see what valuations are on. Because I always sort of want to ask, why is that stock hitting a 3-month high? There's clearly more buyers than sellers. So why are there more buyers than sellers? And so you look at it, often you can dismiss it within a minute, just so it's not for me, it's too highly valued, I'm quite disciplined about valuations. So, there's just lots of stuff, and I read a lot, I read all the magazines, the Money Weeks, the Investors Chronicles, or whatever, and you get ideas. I read the New Year tips, and then I look at them, and I go, oh, that's interesting.
So what's the bit that gets you across the line? The bit that is for me. What is the hook that says this is a good company?
A lot of it is, valuation is really important to me, and I want to see the scope for a re-rating. If you can get a re-rating and earnings upgrades, then that's fantastic. That's your sort of double whammy. And management's important. So, a sort of long time stock, well, long time, it's not the longest. So, there's a couple of stocks that I bought in 2014 that are still in the portfolio and I love and have made a lot of money. But one I bought, probably 4 years ago was SDI Group. And that's really a management play in that, the executive chairman and CEO, they're building a company through acquisition. And they're disciplined about what prices they pay, and also they're keeping it very much within the thematic sector they're working in, sort of scientific digital equipment, as it used to be called. And I like that because they're very disciplined about what they pay, so you're getting these earnings enhancements each time they do an acquisition. And the stocks commanded a decent rating on the back of that. It's actually been re-rated in the last year. De-rated, So a year ago, it's an April year end, it was on about 37 times to April 23. And I then halved my position. I have, for every stock, I have a ranking of low, medium or high risk. I don't have any stocks in my portfolio that I consider high risk. So all of them are low or medium. And I have a low, medium or high reward. So the ideal is to have low risk, high reward.
Of course. And
the reward is sort of based on what upside I think the share price has in it. So something like SDI, I reduced. I halved it. and because of the rating, I just thought that the reward was no longer high because it would need to be re-rated further from there. Anyway, it's now on about 16 times April 23 earnings, and that's for two reasons. Partly the share price dropped,
Yeah.
but the earnings forecasts have nearly doubled because of the acquisitions they've made over the last year.
Yeah.
So at 16 times, 6.5, that to me looks more attractive. And I've been building my position back up.
Yeah. Okay.
I've done 2 or 3 purchases in the last, 4 or 5 months, building it back up.
Okay. Let's talk. I mean, you've mentioned a range of stocks, but I'd like you to almost give me the elevator pitch of different flavors. So let's start with a new entrant into the portfolio.
Okay, new entrant. Quite a few of them have been in the resource area.
That's
so
fine.
I mean, I mentioned Harbour earlier on, but Glencore.
Okay.
I've added to the portfolio in the last sort of few weeks, and that's mainly due to its copper exposure.
Okay.
And you know, you're looking at a stock there on what, 5 or 6 times, I think, earnings. Plenty of cash flow, is paying dividends, and projected yield for this year is 9%. And actually, I want to go back to it because dividends to me are very important.
Yeah.
In July last year, I added to my Sylvania Platinum at 97p. It's now 97p, so I haven't made any money. I have actually. I've had 15% of dividends.
Yeah. And that's actually, it's interesting. We had Gervais Williams here a month ago or so, and that's exactly what he was saying, that actually, if you look at a high inflation environment in the UK index, it's all old school, it's cash flow generating, while the capital return might be flat. You've got this amazing compounding effect of the dividends, etc., coming through, and it tends to outperform other markets during that.
And it's also, and obviously, the JIC portfolio is a closed portfolio, so that cash just gets reinvested and compounds up. I mean, on the income, last year, the dividend income in that portfolio was 17,000-ish. First year in 2012, it was 2,000.
Yeah.
And in 19, so the year before COVID, it was about 12. So it's grown nicely. This year, it's going to be, so far it's 27,000. It's probably going to be about £29,000 for the year. And that just stays in the thing and is being reinvested. Yeah,
but it's, that's the grow your wealth slowly approach. Okay, let's take another type.
Actually, I need to give you one. I've also bought IOG a few months ago.
Yeah, okay, very similar kind of,
luckily.
Yeah.
Luckily, it was a 2.5% position, so it was at the bottom end.
Yeah.
But that's halved.
Okay.
And again, I had to make a decision with that. And on the day of its profit warning in early October, wasn't it? Mid-October. On the day of that, I knew I couldn't get out.
Yeah.
Anyway. B, I have a slight sort of, I know I'm a diary and stuff, but I don't think it would look great if I tweeted it, sent a message out at 8:15 saying I'm out, got out on the first minute at this. So there's a bit of that in there. But also I looked at it and I just thought, I'm not going to be able to get out. And it dropped. And it went all the way down to about 7p. And I updated on that 3 times that day. I mean, I said to start with, just have to let the dust settle. Then it was down at 7. Anyway, and I think that was the right thing to do. I know some people who are, I know got out and they sold at 7, 8. They just say, I get out, doesn't matter.
Yeah.
And I think often that does make sense, but I felt in this it didn't make sense. It was the wrong thing to do. Anyway, it's back up to 12, 13p. There's been changes at the top, and I'll stick with it for the time being.
Okay, so we talked about new entrant, we talked about detractor. Talk about an old favorite, something that's used, but I think compounding is about sticking with something over a long period of time. Give me an example of something that's...
Well, one of my best investments has been Bioventix.
Okay.
Which I bought in October 2014. and it's up about sixfold. It was at its peak up around eightfold. And that's another one where actually, you know, at the end of last year when I was worried about the outlook, I reduced some of my higher growth. So that was reduced, but I have been rebuilding that. I've done 2 purchases, one back in June-ish, May, June, and one in September when they put a trading statement out. And that's just a wonderful company because it's very high return on capital. I'm talking 70%. Mm-hmm. Gross margins are sort of 90%, net margins of 70%, 69 or something. And significant barriers to entry. And also a business that sort of just keeps ticking on. It's not, you know, we're in recession next year. It won't make any difference to their business at all. Yeah.
Yep.
And it's, I mean, I don't know if people know what it does, but it's very simple. You get sent by your doctor to, he thinks you might be low on vitamin D. He sends you to the hospital. You have a vitamin D test. It'll go into a machine probably made by Siemens or Philips, and the result will come out. Well, Bioventics make the sort of antibody that will detect whether you are high or low in vitamin D, and every time they sell, every time one of these tests is done, they get, you know, royalty of threepence or whatever. So it's very high margin, and once it's in there for years. You know, Siemens don't switch every year or whatever. It'll be there for 7, 8, 9, 10 years.
Okay, and then we can end up on the stock side, on a sweet note, a positive contributor, something that this year has done really well for you.
Okay, well, the best ones have been the resource stocks.
Yeah.
So things like BlackRock, World Mining, Serica actually is up 24% this year, despite coming off.
The extraordinary valuation in that
they're
business.
On 3 times cash flow and paying decent dividends, and that will grow.
Yeah. Okay. Well, John, it's been a pleasure having you on, and I think you've given everyone a really good flavour. So, where can we see, if what people want to see the newsletter? Where do they go?
It's JICUK.com. So John's Investment Chronicle.
And if you want to subscribe, all the terms, etc., there on that website.
It's all there, and basically, if you sign up and you just think, actually, it's not what I expected. It's not really what I want. If you within 30 days just cancel, you get your money back. So
okay, that's great. And finally, I mean, you know, I think we've got this picture of you like staring at screens and managing your portfolios and researching and reading. Clearly, everyone needs to have balance in their life. So I wanted to a couple of things. I mean, I think you're an experienced investor, particularly as we're trying to educate people. Is there anything you'd recommend people read?
There's a book. Yeah, okay. I think probably one of the best books I've read is called The Art of Execution by Lee Freeman Shaw.
Okay.
And that's more about, I've read it about 3 times. I'm not getting much better at cutting. I should be better at cutting, having read, you know.
Yeah.
But it's all about investors falling into different categories.
Yeah.
Because his premise was that actually it all comes down to how you manage a portfolio rather than the stocks you pick. He thinks, you know, you throw a dart at a wall, stop, then you buy it.
Yeah.
And it's then how you handle that. And there's, he calls rabbits of people who, when that stock goes down and down, just look at it and just hope it will go up, but it keeps going down. And then he has connoisseurs who buy more of something if it goes up. But the main thing is cutting. The assassin is the main thing.
Yeah.
And the assassin is the person who, when a stock goes down 10% or whatever, just goes, right, I'm out. I'm out, back to cash on that, look for another stock.
Right.
And it's very good in terms of just going through.
Okay, that's good. And then what do you to manage yourself? I mean, I particularly think it's sort of imagine you're back at the mini budget, etc., and all the volatility that followed. What do you do? Do you get out on a bike or?
Um, I go to the gym and things like that, so I do that. I play a bit of golf really badly. I'm trying to sort of learn. I'm in a choir. I joined a choir about 6 years ago, so I'm in a choral society, Battersea Choral Society. There's
Very
a
good.
plug. 3 concerts a year, so that's great. So tonight we've got our weekly. I love that because when you're at choir for 2 hours, you can't think of anything else except trying to get the notes right and making it sound good.
Excellent. Look, it's been a pleasure talking to you. And look, I hope that you get to continue reading the research. But I think when companies come round, etc., I'd love to get you to meet with them as well as part of your ability to get new ideas, etc. So we shall keep that in mind.
Yeah.
John,
Good.
a pleasure to have you on the show.
Great. Thank you very much. Enjoyed it.
Thank you.